Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the dismal science of economics and turns it into a full-blown circus of absurdity. I'm your host, the guy who reads central bank statements so you don't have to, and today, oh boy, do we have a doozy for you. It's July 28, 2025, and the Federal Reserve is back at it, playing the world's most high-stakes game of, will they or won't they? Spoiler alert, they won't. But stick around, because the drama, the data, and the sheer economic lunacy behind this decision are hotter than a crypto bros Lumbo parked in the Nevada desert. Let's dive in. Alright, folks, let's set the scene. It's 2025, and the Federal Reserve, under the ever-beleaguered Jerome Powell, has decided to keep interest rates steady. Yep, no cuts, no hikes, just a big ol' meh. But don't let the snooze fest fool you, this non-decision is packed with more economic intrigue than a season finale of Succession. The Fed's policy meeting this week, running from July 28 to August 3, is shaping up to be a battle royale, with Powell caught between a slowing labor market, Trump's Twitter tantrums, X-platform rants, and the ghost of inflation past. And let me tell you, the stakes couldn't be higher. So, let's break this down, Boss Economics World style, from the surface-level clownery to the deep, dark economic underbelly. Buckle up. First up, let's talk about the elephant in the room, or should I say, the former president in the Fed's boardroom. Donald Trump, the man who never met a central banker he didn't want to fire, is back at it, pressuring Powell to slash rates faster than you can say, art of the deal. Trump and his allies are screaming that borrowing costs are too high, and honestly, it's hard to blame them for wanting cheaper money, who doesn't love a good debt binge. But here's the kicker, Trump's own trade policies, specifically those juicy tariffs, are part of the reason the Fed's hands are tied. Oh, the irony. It's like setting your house on fire and then yelling at the fire department for not bringing enough water. Now, let's add some spice to this drama. Inside the Fed, we've got potential dissents brewing, yes, dissents. Fed Governor Christopher Waller and Vice Chair Michelle Bowman, both Trump appointees, are reportedly itching to vote for rate cuts, citing a labor market that's on the edge. Waller even hinted at this earlier in July 2025, saying the Fed should act now to prop up employment. And Bowman? She's been dropping hints since June that she's ready to cut if inflation stays tame. If both dissent, it'll be the first time two governors have done so since 1993. Coincidence? Or are they auditioning for Powell's job when his term expires in May 2026? I mean, come on, folks, this is less about economics and more about political theater. As Michael Farrelly from JP Morgan put it, these dissents might just be more about auditioning for the Fed chair appointment than about economic conditions. Oof, shots fired. Okay, enough of the soap opera, let's get to the meat and potatoes, or should I say, the data and the dollars. Why is the Fed so paralyzed? Well, it's all about the two-headed monster of inflation and employment, with a side of tariff-induced chaos. Let's start with inflation. The Fed's got this pesky 2% target, right? But here's the thing, inflation's been a bit of a tease lately. According to the latest Consumer Price Index, CPI, data from June 2025, underlying inflation rose by less than expected for the fifth straight month. Sounds good, right? Not so fast. Tariffs are starting to bite, with price increases popping up in goods like toys and appliances. But, and this is a big but, these price pressures haven't gone full-blown bananas yet. Why? Well, as Gregory Dacko from EY Parthenon points out, businesses have been stockpiling inventories to dodge tariffs, and supply chains are sharing the pain. Translation, the tariff bomb hasn't fully detonated, but the fuse is lit, baby. Now, let's flip to the labor market, because this is where things get dicey. The monthly employment report, due out on August 1, 2025, is expected to show a slowdown in hiring for July. Economists are pointing the finger at, you guessed it, Trump's trade policy uncertainty. Businesses hate uncertainty more than I hate decaf coffee, and they're hitting the brakes on hiring until they know what's what. Just look at the numbers, the U.S. added only 136,000 jobs in June 2025, down from an average of 223,000 per month in 2024, according to the Bureau of Labor Statistics. And the unemployment rate? It ticked up to 4.2% in June, the highest since late 2023. Not exactly a crisis, but definitely a yellow flag. No wonder Waller and Bowman are sweating bullets over employment while the rest of the Fed is still obsessing over inflation. It's like watching a family argue over whether to fix the leaky roof or the broken furnace, meanwhile, the house is falling apart. Now, let's zoom out, folks, because this isn't just about the US economy, it's about the global economic dumpster fire that tariffs are fueling. Trump's trade policies have been a roller coaster since he took office, but in 2025, they're hitting new levels of chaos. Just look at the data, US tariffs on Chinese goods alone have climbed to an average of 25% in 2025, up from 19% in 2024, according to the Peterson Institute for International Economics. And China's retaliating, slapping tariffs on US exports like soybeans and tech components. The result? Global trade growth is projected to slow to just 1.5% in 2025, down from 2.6% in 2024, per the World Trade Organization. That's not just bad news for Wall Street, it's bad news for Main Street, too, because slower trade means fewer jobs, higher prices, and a whole lot of economic grumpiness. But wait, there's more. Let's talk about the ripple effects on emerging markets, because they're getting clobbered. Countries like Mexico and Vietnam, which have been trying to capitalize on the US-China trade war by becoming manufacturing hubs, are now caught in the crossfire. The Mexican peso has depreciated by 8% against the dollar in 2025, and Vietnam's export growth has slowed to 4% from 12% in 2024, according to the International Monetary Fund. Why? Because tariffs don't just disrupt US-China trade, they disrupt global supply chains. And when supply chains sneeze, emerging markets catch a cold. So, while Powell's busy dodging Trump's barbs, the rest of the world is dealing with the fallout. Classic. So, here's the million-dollar question, or should I say, the $2.5 trillion question, because that's how much the Fed's balance sheet is still worth in 2025, what's the Fed supposed to do? If they cut rates now, they risk stoking inflation, especially if those tariffs finally kick prices into overdrive. But if they wait too long, they risk letting the labor market tank, which could spiral into a full-blown recession. It's a classic central banker's dilemma, and Powell's stuck right in the middle, trying to thread the needle while Trump's yelling at him from the sidelines. And let's not forget the market's expectations, because Wall Street's got its own agenda. Interest rate futures are screaming for a rate cut in September 2025, with a 78% probability according to the CME FedWatch tool as of July 28, 2025. Investors are practically salivating at the thought of cheaper money, but here's the thing, markets have been wrong before. Remember 2023, when everyone thought the Fed would cut rates early, only to get blindsided by a hawkish pivot? Yeah, me too. So, while the Fed's post-meeting statement on July 30th and Powell's press conference are going to be dissected like a frog in a high school biology class, don't hold your breath for any big reveals. Powell's a pro at saying a whole lot of nothing, and I'm betting he'll stick to his script, we're data-dependent, inflation's above target, blah blah blah. Okay, folks, let's bring this home. What does all this Fed drama mean for you, the average Joe or Jane trying to pay your mortgage, save for retirement, or just afford a decent cup of coffee? Well, if you're a borrower, steady rates mean no relief on your loans, sorry, student debt warriors, you're still on the hook. If you're a saver, it's not much better, because those measly savings account yields aren't budging. And if you're an investor, buckle up, because the uncertainty around tariffs, trade, and Fed policy is going to keep markets choppier than a boat in a hurricane. But here's the real kicker, this isn't just about 2025. The Fed's decisions, or lack thereof, are setting the stage for the next decade. If they mishandle this balancing act, we could be looking at stagflation, high inflation, low growth, and a whole lot of misery. Just look at the 1970s for a history lesson. Or, if they overreact and cut rates too soon, we could be back in bubble territory, with asset prices soaring and inequality widening. Either way, the Fed's walking a tightrope, and the safety net's looking pretty thin. So, there you have it, folks, the Fed's latest non-decision, served up with a side of political drama, economic uncertainty, and global chaos. Is this the beginning of the end, or just another day in the mad world of central banking? Only time will tell, but one thing's for sure, here at Boss Economics World, we'll be watching, laughing, and breaking it all down for you, because if the economy's going to be a circus, we might as well enjoy the show. Until next time, keep your wallets tight and your skepticism high, this is your host, signing off.